Gold moves first. Silver doesn't just follow, it accelerates. And platinum quietly confirms something far bigger is unfolding. This wasn't a rally built on headlines. It wasn't driven by fear or excitement. And it certainly wasn't meant for the public to notice this early. Three metals moved together, not by coincidence, but by pressure. Silent pressure building beneath the global financial system. When assets with different roles, different demand structures, and different liquidity profiles all break at once. History says one thing clearly, something else is breaking too. And the real reason, the one shaping decisions in boardrooms and central banks, is not being discussed where most people are looking. Stay with this until the end, because once you see the pattern, you won't be able to unsee what's coming next. Welcome to Boring Currency Registry. Now, before we go any further, if you've been around long enough to remember when money actually meant something, please consider subscribing, not out of excitement, but out of wisdom, the kind that values preparation over surprise. And tell us in the comments, from which country are you watching today? They did not announce it with sirens. There was no official warning. But the market spoke clearly. On the same day, gold, silver, and platinum reached levels never seen before. This was not normal behavior. These metals do not usually move together, and they certainly do not break records at the same time. When that happens, it is not excitement, it is information. Gold is known as a reserve metal. It reacts to trust, not noise. Silver is both money and industry. It reacts to pressure, not headlines. Platinum is thin, quiet, and sensitive. It reacts when systems are tight. When all three move together, they are not celebrating growth. They are signaling stress. Most public explanations focused on simple reasons. Inflation, interest rates, headlines. These explanations sounded familiar, but they did not explain the timing or the strength of the move. If the reasons were obvious, the move would have happened earlier. Instead, prices exploded suddenly as if something crossed a line. They noticed something else. This move did not come from panic. Stocks were rising. Risk assets were stable. Fear was not obvious. That made the signal more important, not less. Defensive assets usually rise when fear is visible. This time, they rose when calm appeared on the surface. This is how early warnings look. Capital moves before language changes. Large pools of money do not wait for confirmation. They position quietly because waiting is costly. By the time stories are comfortable, opportunity is already gone. They also saw how the move ignored resistance. Prices did not hesitate. They did not test levels slowly. They pushed through them. That kind of behavior suggests urgency, not speculation. Someone was not trying to win. Someone was trying to protect. In history, moments like this appear before bigger shifts. Currency changes, policy stress, liquidity problems. Not every signal leads to crisis, but every crisis is preceded by signals like this. This is why the event matters. Not because metals are higher, but because they move together quickly and without permission from the usual narratives. Markets do not explain themselves. They warned first. They did not call it a crisis. No alarms were triggered. Yet something important was quietly being repriced. Currencies are not only tools of trade, they are systems of trust. When confidence is strong, money flows toward growth, yield, and risk. When confidence weakens, capital does not run. It relocates. That is what was happening beneath the surface. Gold did not rise because people were afraid. It rose because large holders were adjusting balance. Silver did not rise because it was cheap. It rose because it sits at the edge between money and necessity. Platinum did not rise because it is popular. It rose because thin markets reveal stress faster than deep ones. They noticed a key contradiction. Official messages spoke of stability, strong data, and controlled inflation. At the same time, money was moving away from promises and toward assets that do not depend on policy. This gap between words and behavior is where real signals live. Interest rates were expected to fall later, not now. Economic numbers were not collapsing. There was no emergency. That made the timing strange. Capital usually waits. This time it did not. It acted early, as if patience carried risk. The dollar weakened, but not in panic. It slipped in confidence. That matters more. A falling currency during calm markets suggests repositioning, not escape. It means global players were adjusting exposure, not reacting emotionally. They understood something important. This was not about inflation today. It was about credibility tomorrow. When debts grow faster than control, when systems depend on constant adjustment, trust becomes fragile. Fragile trust does not break loudly. It erodes quietly. Precious metals benefit from this erosion. They are not promises. They do not require confidence in leadership, policy, or future decisions. They simply exist. In times like these, that becomes valuable. This repricing did not happen on television. It happened in balance sheets. It happened in allocations measured in decades, not quarters. By the time explanations reach the public, the movement is already mature. What looked like a metal rally was something else entirely. It was confidence changing direction, without asking for attention. They could explain prices with charts. They could debate policies and currencies. But they could not escape one problem: supply. Unlike stocks or bonds, precious metals cannot be created by decision. They must be pulled from the ground, refined, and delivered. This makes them slow, rigid, and unforgiving. When demand rises suddenly, supply does not respond. It resists. Silver sits at the center of this tension. It is essential for electronics, energy systems, and advanced manufacturing. Each year, more silver is consumed than recovered. Mining output struggles to grow, while industrial demand quietly expands. This is not a theory. It is a physical imbalance. Platinum is even tighter. Production is concentrated in a few unstable regions. Labor issues, energy shortages, and political pressure restrict flow. Inventories are thin. When interest increases, even slightly, the market reacts sharply. Platinum does not forgive delays. They understood that paper markets hide this reality. Futures contracts can multiply supply on screens, but not in warehouses. When enough participants want delivery instead of exposure, the illusion weakens. Price then adjusts violently. This is why the move mattered. It was not driven by headlines or optimism. It was driven by constraint. Physical metals were being valued more highly than financial representations of them. They noticed another detail. There was no sign of relief. No rush of new supply. No announcement of expansion. The system had no quick fix. That creates urgency, even without fear. History shows that structural shortages do not reverse quickly. They stretch, they pressure, they force repricing until behavior changes. That process is slow to begin, but powerful once underway. This was not a spike caused by excitement. It was a response to limits. Markets were adjusting to what could not be negotiated away. When reality sets boundaries, stories lose control, and prices begin to reflect what exists, not what is promised. They did not rush. They did not celebrate. They moved with intention. When experienced capital senses change, it does not wait for consensus. It looks for protection first, not profit. This is where many misunderstand the role of precious metals. They are not chased for excitement. They are held for stability. They observed how the buying behaved. There were no sharp reversals, no signs of panic entry. Prices climbed with purpose. That pattern suggested planning, not emotion. Institutions do not move loudly. They move early. For business leaders and long-term decision makers, this behavior carries a lesson. Markets reward preparation, not reaction. By the time explanations feel comfortable, positioning becomes expensive. The risk is not missing upside. The risk is being exposed when options disappear. They also understood that overbought conditions do not mean danger. In structural shifts, assets can remain extended for long periods. Waiting for perfect entry often results in no entry at all. Smart capital accepts uncertainty but avoids vulnerability. Precious metals play a specific role here. They reduce dependence on systems that require constant confidence. They sit outside balance sheets, policies, and political cycles. In times of quiet repricing, that independence matters. This does not mean abandoning growth or innovation. It means recognizing phases. Every cycle has moments when defense becomes strategy. Ignoring those moments is not optimism. It is negligence. They saw that this move was not about timing the top. It was about acknowledging the signal. Signals do not repeat often, and they rarely ask politely. The metals did not shock the world for attention. They moved because capital was preparing. And preparation, in history, always comes before explanation.